What's up guys, it's Business Brainrot, and today I'm giving you the cheat code to stock picking. After analyzing literally thousands of stocks over the last 15 years, from Apple in 2009 to Tesla in 2020 to some absolute trash penny stocks that shall not be named, I can tell you this. 99% of the ratios, charts, and fancy indicators people obsess over are noise. You only need 5 numbers to separate the great companies from the mediocre and the outright dangerous ones. Learn these 5 once, and you can analyze any stock, big tech, banks, retailers, oil companies, biotech, doesn't matter, in under 10 minutes. These are 1. Debt to equity. 2. Return on equity. 3. Free cash flow and whether it's growing. 4. EBITDA margin or just EBITDA growth for early-stage companies. 5. PG ratio. That's it. Master these and you'll beat most Wall Street analysts who get paid millions and still screw it up. And let's dive in. First metric, debt to equity ratio. Ticker symbol D/E. This tells you if a company is swimming in debt or running a clean balance sheet. How to find it? Google company ticker D/E ratio, or just go to Yahoo Finance, type the ticker, click statistics. Rule of thumb for most American investors. 1. Under 0.5 very safe, conservative balance sheet. 2. 0.5 to 1.0 normal, healthy. 3. 1.0 to 2.0 caution zone, depends on the industry. 4. Over 2.0 red flag city, especially if interest rates are high. Examples: Apple right now, around 1.4, totally fine for a mature tech giant. Coca-Cola, usually under 0.8 fortress balance sheet. Now look at something like Ford or GM, often 4, 5, even 6+. That's normal for car companies because they borrow to finance customer car loans. So always compare to industry peers. Real-world disaster example. Bed Bath & Beyond went bankrupt with a D/E over 10 at one point. Debt crushed them when sales slowed. Bottom line, if a company has more debt than equity and can't pay it off with a few years of profits, run then. Second metric, ROE, return on equity. This is the single best measure of how good management is at turning shareholder money into profits. Formula is simple. Net income divided by shareholders' equity. Think of it as, if I give this company $1 of my money, how much profit do they spit back every year? Good ROE. 1. 15% or higher, excellent. 2. 10 to 15% decent. 3. Under 10%, usually boring or broken. Examples: Visa and MasterCard, consistently 35 to 50% ROE. They're printing machines. Apple, around 40 to 60% most years, insane. Walmart, usually 18 to 22%, rock solid for retail. Now compare that to, say, Spirit Airlines or most traditional car companies, often single digits or even negative. That's why those stocks stay cheap forever. It like See's Candy, Coca-Cola, American Express, all crush 20% plus year after year. Third and most important metric in my opinion, free cash flow. This is the actual cash a company generates after paying for everything, the money they can use to pay dividends, buy back stock, pay down debt, or reinvest. Wall Street can play games with earnings, but cash flow is reality. How to find it? Yahoo Finance, then statistics, then free cash flow TTM, or just Google. Ticker free cash flow. 2 things matter. 1. Is FCF positive and growing over time? 2. How does the stock price compare to that cash flow? Rule of thumb I use: if a mature company trades for less than 15 times its free cash flow, it's usually cheap. Example: in 2020, Apple generated about $73 billion in free cash flow and had a market cap around $2 trillion. That's roughly 27x FCF, expensive but growing fast. Monster Beverage, Visa, Meta, these compound because they throw off rivers of growing free cash flow and buy back their own stock with it. If a company has negative or shrinking FCF for years, no matter how hot the story is, stay away. Number 4. EBITDA, earnings before interest, taxes, depreciation, and amortization. I know, sounds complicated, but it's just a cleaner way to see operating profits. Why do we care? Because net income can be messed up by one-time charges, taxes, or interest expense. EBITDA shows the raw cash-generating power of the business itself. 2 ways I use it. 1. EBITDA growth year over year. 2. EBITDA margin equals EBITDA divided by revenue. Good margins depend on industry. 1. Software/tech 25-40% plus is elite. 2. Retail 8 to 15% is strong. 3. Restaurants 10 to 20% is good. Red flag. If EBITDA is shrinking while revenue grows, they're spending like drunk sailors. Seen this with WeWork, Uber in the early days, a million SPACs. Pro tip. For banks and financials, skip EBITDA, they don't use it. Stick to ROE and book value instead. Fifth and final metric, the PEG ratio. This is the only valuation metric you need. PEG equals price to earnings ratio divided by earnings growth rate in percent. Example, stock with PE of 30 growing earnings 30% per year, then PEG equals 1.0 means fairly priced. Rule of thumb. 1. PEG under 1.0 probably undervalued. 2. PEG 1.0 to 1.5 fair. 3. PEG over 2.0 expensive unless something crazy is happening. Real examples. Nvidia in early 2023, PE was high, but earnings growing 50 to 100%, that is PEG under 1 means bargain in hindsight. Tesla in 2020, PE over 1,000, growth was maybe 50%, that is PEG 20 plus means insane valuation, still went higher but dangerous. Monster Beverage from 2005 to 2020, PEG almost always under 1.5 while compounding 25% plus per year. That's how you get 100 baggers. So here's your 5-second cheat sheet you can screenshot. Before you buy any stock, ask 1. D/E under 1.0 or reasonable for industry? 2. ROE over 15% for the last 5 to 10 years? 3. Free cash flow positive and growing? 4. EBITDA healthy and ideally expanding margins? 5. PEG under 1.5, preferably under 1.0. If the answer is yes to all 5, then strong candidate. If 3 or more are red flags, then walk away no matter how much you love the product. That's it, guys. 5 numbers. Learn once, use forever. If this helped you, smash that like button, subscribe, and turn on notifications because I drop these no-fluff videos every single week. See you in the next one. Now go make some smart investments.